Should you invest in crypto for retirement? In recent years, cryptocurrencies have grown in popularity among the general public. Approximately one-third of investors under the age of 55 intend to rely on cryptocurrency as a source of income in retirement. Given the volatility of the cryptocurrency market, this may appear to be a risky strategy, and it is. Terra Blockchain's Luna, a once popular stablecoin cryptocurrency, was wiped out in early 2022, erasing more than $17 billion in cryptocurrency value. In a matter of days, the coin's price plummeted from $116 to a fraction of a penny, making it one of the most dramatic crypto crashes on record. Is cryptocurrency a good long-term investment? With the introduction of Bitcoin in 2009, the modern era of cryptocurrencies began. Since then, Bitcoin has had a mean annual return of 93.8%, which is quite impressive over time. But that doesn't mean there haven't been setbacks. And the return of 2018 was 72.6%, while early investors who held on saw massive returns. Not all coins fared as well. Investors have had mixed results, to say the least. With thousands of cryptocurrencies to choose from, 30% of millennials believed cryptocurrency returns will outperform stock, real estate, and mutual funds. But only time will tell if those expectations are justified. For the time being, it is too early to tell whether cryptocurrency will be a good long-term investment. Most investors under the age of 55 are further away from retirement than any cryptocurrency is. So, while cryptocurrency is undeniably a novel and sometimes trendy new asset class, it is also extremely risky and volatile. Before relying on cryptocurrency for retirement planning, you should think twice and consult with a financial planner. When choosing retirement investments, what should you look for? Expect growth rate. The expected growth rate is an important investment fundamental. Various valuation models are used by stock market and bond investors to forecast growth. This is more difficult with cryptocurrencies. Volatility and risk. The stock and bond markets are both decades of historical data and risk measurement frameworks. Cryptocurrencies are not only riskier and more volatile than stocks or bonds, but measuring their risk is also more difficult. There are only a few models available for measuring cryptocurrency risk. Cash flow. Many investments provide consistent cash flow in the form of dividends, bond coupon payments, and other forms of cash flow. Because of staking and yield farming, several cryptocurrencies outperform more traditional investments in this area. However, it is possible that when one person retires in 10 to 20 years, these newer systems will no longer function the same way. Of course, just because something is new and untested does not automatically imply that it is a bad investment. The investor has the final say on whether to put their money, so they should always weigh the pros and cons before making a decision. Where crypto fits in an investment or retirement plan. Many investors should avoid including cryptocurrency in their retirement investment entirely due to the risk, volatility, and difficulty predicting the future of cryptocurrency. If you decide to include cryptocurrencies, it may be best to keep them as a smaller portion of your overall portfolio. Unless you're a firm believer in cryptocurrency and want to take advantage of the tax benefits of a cryptocurrency IRA, you might be better off keeping cryptocurrency as a small part of the overall portfolio and out of your retirement. Many investment experts recommend investing the majority of your retirement assets in stocks, preferably in low-fee, diverse exchange-traded funds, ETFs. High-risk alternative investments are still permissible, but only for a portion of investments that are not critical to your future livelihood. Consider the scenario when developing your cryptocurrency investment strategy. If you invest $5,000 in cryptocurrency and it increases by 10%, you would have $50,000. That's a fantastic return. But would it be enough to derail your retirement plans if it dropped to zero? Most likely not. While the $5,000 example may be appropriate for some individuals or households, your investment portfolio, risk tolerance, and financial objectives are unique. You can decide on the best allocation of your retirement portfolio and other investments if you understand your investments and how each asset works. Cryptocurrency could fit into either of those investment strategies. However, if you intend to rely on assets for retirement, invest with caution.